Hello traders, and welcome back to Explain the Charts. Today is November 23rd, 2025, and we're taking a deep dive into USDJPY, a pair that is flashing some critical signals at multi-year highs. We'll start by dissecting the latest news and fundamental drivers before jumping into the charts to map out our key levels and potential scenarios. The dominant theme for USDJPY remains the massive monetary policy divergence between the United States and Japan. The U.S. Federal Reserve remains focused on inflation, leading to a hawkish stance that keeps the U.S. dollar strong. In stark contrast, the Bank of Japan, or BOJ, is maintaining its ultra-loose, dovish monetary policy. This policy gap is the primary engine pushing the dollar higher against the yen. Recent economic data out of Japan has only reinforced this narrative. Japan's latest third-quarter GDP report showed a contraction of 0.4%, which has significantly dampened any speculation of a BOJ rate hike anytime soon. This weak growth suggests the BOJ will be forced to remain accommodative. Furthermore, the new cabinet under Prime Minister Takaichi recently approved a massive 21.3 trillion yen stimulus package. While aimed at boosting the economy, such a large fiscal stimulus often weighs on a currency, adding another bearish factor for the yen. However, as the pair continues to climb, we're hearing more and more noise from Japanese officials. This is what's known as verbal intervention, where officials warn against excessive, one-sided currency movements. The market is now on high alert for the threat of direct market intervention, where the BOJ would sell US dollars to artificially strengthen the yen. News reports indicate that traders are viewing the 158 and 160 levels as the most likely triggers for such an action. We saw evidence of this fear last Friday, November 21st, when the dollar weakened against the yen following intensified verbal warnings. Now, let's transition to the charts to see how this fundamental story is playing out in the price action. Looking at our daily chart, we can see the broader context of this powerful uptrend. After a significant drop in July and a bottom put in around the 141.50 area in early August, the pair has been in a relentless climb for months. This uptrend has been orderly, with periods of consolidation followed by strong bullish impulses. The break above the psychological 150 level in October was a major technical milestone, signaling further strength. Now let's zoom in on the price action since September to get a clearer view of this recent acceleration. As you can see, the momentum really picked up in November, with the price surging from the low 150s. The price pushed all the way up to a high of 157.89 on November 20th. This brought it right to the doorstep of that 158 level we discussed, which is a key psychological and potential intervention zone. Then, on Friday the 21st, we see this large bearish candle, showing a sharp rejection from those highs. This pullback correlates perfectly with the news of intensified verbal intervention from Tokyo, showing how sensitive the market is to this threat. To understand this rejection better, let's switch to the 15-minute chart for a micro-level view of last week's trading. Here we can see the aggressive buying that occurred on November 19th and 20th, pushing the price to its peak. But look at the price action on the 21st. We see a stunning reversal, with a sharp drop that broke through several short-term support levels. This is the market showing its nervousness. Traders who were long began taking profits, fearing the BOJ was about to step in. The volatility here was significant, highlighting the risks of trading at these elevated levels. Switching back to our daily chart, we need to put this pullback into perspective and define our key levels going forward. The immediate resistance is clearly the recent high around 157.90. A break above this level would open the door to the targets mentioned in the news, 158.88, and then the major psychological barrier at 160. On the downside, the first area of minor support sits around Friday's close near 156.38. However, the more critical support zone to watch is the 155 level. This area was a recent breakout point and a psychological handle, so holding above it would be very bullish. If we lose 155, the next significant support levels come into play near 153.60 and then 153.00. So, let's recap the important points and outline our potential scenarios. The bullish case remains strong from a fundamental perspective. As long as the BOJ remains dovish and the Fed stays hawkish, the path of least resistance for USDJPY is upwards. Bulls will be looking for price to hold above the 155 support level as a sign that this is just a temporary pullback. A sustained break above the 158 resistance would signal a continuation of the trend, though this would dramatically increase the probability of direct intervention. On the other hand, the bearish case is primarily driven by this intervention risk. The sharp rejection from the 158 area is a clear warning sign that the market is hesitant to push prices much higher without a fight. A break and close below the 155 support level would be a major victory for bears, suggesting a deeper correction towards 153 could be underway. The ultimate bearish catalyst would be a surprise hawkish shift from the BOJ or a sudden dovish pivot from the Fed, but that seems unlikely right now. So here are my unbiased predictions. The most likely scenario, which I'd give a 60% probability, is a period of consolidation and range-bound trading, likely between 155 and 158. The market needs to digest the recent move and gauge the BOJ's true intentions, leading to choppy price action. This becomes more likely if upcoming U.S. economic data is mixed. A bullish continuation scenario has about a 30% probability. This would require a catalyst, such as hotter-than-expected U.S. inflation data, to give bulls the confidence to push through the 158 resistance and challenge the intervention threat. Finally, a bearish reversal scenario has a low probability, around 10%. This would likely require a break below 155, which could be triggered by surprisingly weak U.S. economic data or an unexpected hawkish statement from the BOJ. Keep an eye on the upcoming U.S. GDP and core PCE inflation figures, as they will be the next major market movers. To recap the most important levels, resistance is at 157.90, 158.88, and 160.00, while key support lies at 155.00, 153.60, and 153.00. That's all for today's analysis on Explain the Charts. Please remember, this video is for informational purposes only and is not financial advice. Always conduct your own research and analysis before making any investment decisions.